You've heard of Citigroup and JP Morgan, probably even know who Jamie Dimon is. But who runs BlackRock or Rocket Mortgage? Who's the biggest marginal buyer of US treasuries? These are the shadow banks and the shadow bankers. Many people may have heard some of these names, yet don't really know what it is they do or why they become so important to keeping the entire world running. BlackRock might be the best known of the bunch, but it's hardly the only one. On the plus side, shadow banks have stepped in and filled a massive role vacated by the retreat of regulated banks in the wake of the 2008 monetary and banking crisis. It wasn't a financial crisis. Shadow bankers were able to deliver some significant relief in terms of intermediation and credit redistribution as depository institutions were permanently impaired by 2008. Now, the downside is that shadow banking has made the financial world even more complex and even more opaque. I mean, they were always there from the early days of the Eurodollar system, playing critical roles in its development and its domination. But the monetary panic of 16 years ago opened the door for them to take on an even larger role, even if doing so back further into the shadows again. While the government rightly has shown a spotlight on what some of the banks were up to, regulators haven't been able to illuminate nearly as much of these others. As Ben Bernanke said in August 2011, amidst another monetary crisis, one that was greatly amplified by the behavior of one class of shadow banks, Bernanke said they should not exist. Unfortunately, they do. What has raised concerns for regulators and central bankers and even market participants is that shadow banks don't have a backstop. Their only real recourse right now is the same wholesale marketplace and money dealers that have supported them this entire time. And as much as shadow banks have become increasingly vital for intermediation, they actually make money dealers that much more important for what shadow banks are not. It isn't just banks that are sitting there in the center of the Eurodollar black hole. It is constantly changing, constantly evolving and shifting with the times and the circumstances. The shadow banks have been there all along, and now they're a bigger part of it, for better and for worse. More recently, regulators have sounded the alarm on the rise, the real rapid rise of shadow banks in certain parts of the financial system. We'll start with November of 2023. As Bloomberg reported back then, after months of back and forth, Washington's top financial officials on Friday, again, November 2023, released a new framework for designating financial firms as systemically important. That too big to fail tag, which brings significant compliance costs and regulatory headaches, has mostly been applied to large Wall Street banks since its introduction more than a decade ago. For months, Biden-era regulators have been warning that non-banks' footprints across finance have significantly expanded, though oversight hasn't kept pace. Officials have said that unforeseen risks may be lurking as the firms have grabbed even more market share while their ties to traditional lenders have become more complex. And that's because of the nature of what shadow banks are and what shadow banks are not. And what they are, as the article said, is an increasingly huge part of the financial system. As was reported last year in February, the amount that U.S. banks have loaned to so-called shadow banks surpassed the $1 trillion mark, according to the Federal Reserve data, even as regulators warn of potential risks to the financial system. So what are shadow banks? One thing is they're not really banks. They're balance sheets, they're investment firms, they're other pools of assets that have arisen largely since 2008 in the wake of the fact that banks have been permanently impaired, paging 1983 Ben Bernanke. One of the original shadow banking sectors has been something like money market funds. And money market funds arose as a way for regulated depository institutions to circumvent often ridiculous ancient regulations. Regulators are always fighting the last battle and imposing their wills on a system that is, in many cases, no longer exists. And so in a money market fund, you have a bank that instead of having say, $1 million in deposits, and therefore that $1 million in deposits is subject to reserve requirements, which can be very expensive, instead the bank, especially in the 1970s, banks did this quite frequently. They would encourage their depositors to buy equity, essentially, in money market funds, which is a separate balance sheet and institution, a separate firm, essentially, take that $1 million and then re-lend it to the bank in the wholesale marketplace, such as repo, and therefore the bank would have the same $1 million in funding, but it would no longer be deposits, and instead as a wholesale loan, that meant that it was no longer subject to reserve requirements. So the cost of funds might be the same or even better because it's repo, depending on the amount of collateral that's being used, but the bank saves in not having to be subjected to the reserve requirement. So even just money market funds as a form of shadow banking were a way to extract cash out of the regulated depository system and move it through wholesale to make it more dynamic, more mobile, and less subject to regulatory and government interference. And this, by the way, is a topic that we cover extensively at Eurodollar University in all our subscriptions, whether it be the memberships or the deep dive analysis. We're always looking at how the Eurodollar system evolves as well as how it operates when it does evolve. So check out our subscriptions, the deep dive analysis, the memberships, even the daily briefing at our website, eurodollar.university. But these shadow banks go beyond money market funds and working with the general public, non-bank customers. In the most traditional view, the way we think about banking and money and lending, a bank takes in deposits and fractional reserve lending and then lends out to the public. It's a bank, it's a single institution, it's a single step between the borrower and the holder of funds. At least that's what you're taught in the textbooks. Well, a non-bank shadow bank firm takes things just one step further. So you have the bank that creates the bank form of money, this ledger money, but rather than lending to an end customer, it instead lends through these wholesale markets to another financial firm, and then that financial firm lends to the ultimate customer. So the bank is one step removed from the ultimate borrower. And the development of wholesale markets have made this absolutely positive, which is one reason why collateral is such an important thing. So these other financial firms, they're not banks, they don't take in deposits, therefore they're not subject to the same bank regulations because they're not really banks in that respect, which allows them to undertake specialized forms of intermediation. They're lending to customers largely because they have some kind of specialized knowledge about that market segment or borrowing or some other capacity that maybe banks don't have themselves. So it's not like we need banks to always do intermediation. We can have specialized boutique financial firms and have had specialized boutique financial firms throughout the entire history of the modern industrial economy. They've always been there, but they become increasingly important as this black hole model, the Eurodollar system, has evolved. So whereas money market funds were ways to extract cash from the regulated banking system and therefore kickstart this wholesale marketplace, redirect cash to other places in it, these other forms of shadow banking are basically beyond that first formal step in the process because non-banks extract financial processes from the regulatory depository system largely because they're not regulated and therefore don't have the same constraints to operate in the marketplace. And unlike money market funds, shadow banks take in equity, then are highly leveraged to do what they do to generate returns in intermediating in the real economy. They've become what banks used to be on that side of their balance sheet. So they've taken things a step further than money market funds. So a bank is a deposit-taking institution that relends those funds, used to relend those funds to the borrowing customer, the general public, whether it be businesses or individuals. A non-bank shadow bank is essentially a financial firm that sits in between the bank and its ultimate customer, the ultimate borrower in these chains of assets and liabilities that get created through wholesale markets. And it's absolutely essential to have these wholesale markets because it redistributes cash as well as collateral to allow all of these things to be connected together. So non-banks can't work without the wholesale marketplace because they depend upon those wholesale markets for funding, for leverage, and their very existence, which means, as we'll see at the end here, dealer banks are critical to their operations. We've seen the rise of shadow banks from really, again, as the Eurodollar itself evolved, they had money market funds come in, especially in the 1970s, because they were shadow banks right there from the early days of the Eurodollar system. Hedge funds, special purpose vehicles, the stuff that got into asset-backed securities and securitizations, those are forms of shadow banks as well. So they've been around a very long time, but here's the thing. Their importance has grown since they have become the marginal source of balance sheet expansion for the entire system. Because the 2008 crisis constrained depository banks by the history of the crisis as well as regulation. There's so many legacy problems in the regulated banking system. The existence of non-banks, these shadow banks, allowed shadow banks to take advantage of partly take advantage of that opportunity. And so now you have things, for example, where it used to be Wachovia and Countrywide that extended mortgages into the mortgage market, housing market. Now you've got firms like Rocket Mortgage and Quicken Loans, non-deposit taking financial firms. They're basically balance sheets that have the ability to expand using leverage that they can obtain in wholesale markets. So there's significant pools of assets, but they're just not deposit-taking firms. They're not deposit-taking banks. But they do intermediate the circulation and flow of credit through the system. The money comes from the banking sector and then gets redistributed through wholesale markets to these shadow banks, and therefore from the shadow banks to the ultimate real economy customers and participants and borrowers. While that's a good thing, there's nothing wrong with that taking place. In fact, we want specialized financial firms to be able to intermediate in the marketplace. That's a tremendous increase in efficiency of money and credit. The downside to all that is it leads to, in this format, even more information asymmetry. It's why it's hard to know what's happening behind the scenes. Because shadow banking creates, anytime you get into a situation where there's lots of information asymmetry, you don't really know what's happening inside these wholesale marketplace or what's going on in the balance sheets because there's no regulation that forces them to be transparent. That's what regulation should be focused on. You've got these vulnerabilities that include long chains of liabilities and assets that get transacted all over the place, collateral chains that are very important as well because repo is at the center of all of this. And the regulatory changes never keep up with it. This is why traditional banking oversight doesn't apply because these are not actual banks. So governments and regulators are looking at the banking system for the problems that they caused up until 2008. Meanwhile, over here, these shadow banks who have been in the background the entire time, taking a more primary role since 2008, but since they're outside of the regulated banking sector, we don't have much information on them. We know they're there. We know they're doing things just like the Eurodollar, but like the black hole, they're still in the center doing things beyond our ability to illuminate their activities. And going back to the February 2024 article, regulators have been warning that oversight hasn't kept pace with the significant expansion across finance of non-banks' footprints. Unforeseen risks may be lurking as the firms have grabbed more market share, while their ties to traditional lenders have become more complex, officials have said. And what they're really talking about is, again, wholesale markets. So depository institutions, they're the money creators, but instead of extending credit like they used to, and like all the textbooks say, now they extend credit in wholesale markets to they fund the activities of these shadow bank, non-bank lenders who then extend credit, a significant amount of credit, to the real economy. But going from the borrower in the real economy through these shadow banks to then dealer banks in the Eurodollar black hole, it's complicated, it's complex, and it is opaque. Now, even in the 2008 crisis and the subsequent crisis that have followed from it, these Eurodollar cycles that I often talk about here on this channel, non-banks and shadow banks have been a part of it all along. They haven't been front and center. They haven't been the primary reason for those crises, but they were. Back in 2008, for example, the very first instance of crisis came from a money market fund. It was BNP Paribas's money market funds in August 9th of 2007 that really kicked off the crisis. And let's not forget, it was the reserve fund that broke the buck in 2008 that amplified the already substantial negative pressures from Lehman Brothers and AIG and everything else. September 2008, a lot of people remember the reserve fund breaking the buck. And in 2011, Eurodollar number 2, it was money market funds again, this time increasingly front and center at the really where the crisis was becoming more and more difficult. It was money market funds that were yanking US dollar funding from European banks and non-banks alike that was leading to what everybody assumed was a European sovereign debt crisis, but was really another global dollar shortage. This is what triggered Ben Bernanke in 2011 to make that statement. What he said was on August 1st of 2011, finally, just a word about money market mutual funds. They should not exist. Unfortunately, they do. So money market mutual funds, like a lot of other shadow banking types, have been there all along as they have expanded their footprints. Let's not forget the role that money market funds played in the 2023 banking crisis, because there was not a reconnection from money market funds who had cash back into the regulated banking system in time for it to save Silicon Valley Bank, Signature, and First Republic, or Credit Suisse for that matter. So essentially, shadow banks have been there all along. They've just been lurking further back in the shadows, even though they have contributed to some of the downside, as well as the upside in replacing some of the functions that the regulated depository institutions haven't been able to undertake since 2008. But because the shadow banks don't have the legacy baggage that the regulated banks do, nor the regulations that have been piled on up after the crisis, they've allowed the system, the financial system, to have an outlet for redistribution and recirculation of credit outside of the banking system. And the more banks have been impaired, the more opportunity there might be to do something outside of the banking system, the more the shadow banks have grown in that wake. And so you've seen not just money market funds. That's one of the, as I said, that's one of the earliest steps. You've got these specialized financial firms, even the mortgage market. You've got private equity. You've got micro financial firms. You've got hedge funds that have created, it's been a really big part of a whole lot of everything that goes on in the financial system these days, including something called the basis trade. And these hedge funds that are engaged in the basis trade are the largest marginal buyer of U.S. Treasuries in the entire world. So as the banking system is balance sheet constrained, the more balance sheet constraints they become, the more there is opportunity for microfinance and private equity and opaque hedge funds to fill in those roles, but they're all connected together by wholesale markets, which means dealer banks are critical to the operation of everything in the system, including shadow banks. Because what shadow banks are not is they're not banks. They don't have the ability to create money, only the ability to extend credit and take in risk because they're funded from the money creation that still comes from the banking sector. And so because they are not banks, they cannot create funds themselves, they require dealer banks to redirect funding to them, to be connected to wholesale markets. And therefore, they are at the mercy of those wholesale markets and the risk aversion and capacities of those dealer banks. And that especially extends to the collateral that flows through all of these shadow banks as well. Dealer banks are at the center of the black hole, even when we're talking about non-bank shadow banks. So what regulators are really worried about is essentially this setup, this framework, that shadow banks are entirely dependent upon wholesale money market networks like repo because they can't access the Federal Reserve, even though that didn't really help in the 2008 crisis either for regulated banks. But from the Federal Reserve's perspective, these shadow banks, if wholesale markets become increasingly illiquid, problematic, and what's going to happen to these shadow banks? Their funding and their leverage. The same thing that happened to regulated banks in 2008, potentially. Shadow banks could be forced to liquidate their assets because they're highly leveraged, because they depend upon short-term wholesale funding. If that wholesale funding disappears for whatever reason, dealers are more risk averse, the collateral just isn't good enough. Whatever the case, shadow banks that lose their leverage and funding would therefore have to fire sale their assets, which would lead to very similar conditions as what came out in 2007 and 2008. So they haven't solved any of these problems. If anything, the reliance on wholesale markets and funding has just gone and evolved to a different part of the system that was already there to begin with, but took a more prominent role given the constraints and impairment of the regulated banking system. And dealers are still the essence of all of this because they are the requirement to make sure that wholesale markets remain circulating, collateral continues to flow, that wholesale is the lifeblood of the system, even for shadow banks. So while shadow banks are taking on more of the intermediation role, the dealers are still there as the center of the Eurodollar, still circulating and redistributing funds, even as non-bank shadow banks become more and more important in ultimately extending credit to the real economy. So the good side of it is that shadow banks have been able to partly fill the role left behind by the impaired regulated banking system. The bad news is the way they've done it is, in many ways, the same as what led to the 2007-2008 crisis. Now, we're not saying there's a possibility of something like that happening again, but there are vulnerabilities that we don't really fully understand, because as the system has evolved to this more shadow banking at the margins of credit and money, as that system has more and more evolved, we know less and less about it. Thanks to regulators who are always fighting the last battle, looking backwards, focused entirely on the regulated banking system, even as, once again, money and banking constantly evolves. If shadow banks have been there basically from the beginning of the Eurodollar system, that just begs the question, what is the Eurodollar system? I went over that in a video. That's the one I've got linked below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.